The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
With so many people living longer, the fear of outliving your money becomes a reality for many of us. Will I be a financial burden? Will I outlive my money? How will I be remembered? My name is Neil Himmelstein, president of Main Street Planning Group. Please contact me by visiting mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. I will introduce you to strategies that will guarantee you will not outlive your money, that can guarantee you will not be a burden on your loved ones. Through a collaborative approach, we will uncover solutions that offer tax-efficient strategies, lifetime income, and legacy planning, choice, organization, direction, and education. That is the code we stand behind. Contact mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. And listen to me every Friday at 3 p.m. as I host the Main Street Code for Financial Success, right here on 103.9 LI News Radio. Good afternoon. Welcome to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein, and I'm here with you every Friday at 3 o'clock. If you miss an episode, always catch me on Spotify or Apple with the Main Street Code, or check out my website, themainstreetcode.com, where I have past episodes, and you're always free to reach me at 631-647-4694. And when we talk about the code, we talk about choice, organization, direction, and education. And we help hundreds of clients across the country, as well as agents, with regards to insurance needs, whether it's life insurance, it's disability, long-term care, life settlements, and annuities. We do quite a bit of annuities, and we're right on top of the market as to when rates go up and rates go down. And in addition to all of that, we hope that we can become your financial quarterback in helping you connect all the dots with your financial plans. And that's where we strive and hope to be of service to you. And we welcome any questions that you have regarding any retirement, insurance matters, or savings matters. That's where we shine. So today, what I'd like to talk about is a client that had called me about a month ago. I'm sorry, maybe it's 2 or 3 months ago. 90 years old. Apparently, he bought a life insurance policy 30 years ago. Very successful businessman at the time, and he bought a $2 million survivorship policy. For those who don't know what a survivorship policy, the policy's written on him and his wife, and when they pass, their heirs are going to get $2 million. Well, at the time he bought it 30 years ago, he put $250,000 in that he had saved from other insurance policies, and he put that into the policy, and he's been paying $5,000 a year. His agent on this policy had passed away about 12 years ago. He's had this policy a long time. And he called me up and said, "Hey, I didn't get my bill." And I said, "Okay, so let me find out." I did my research, and, I go, "How much are you paying?" It was $5,000 a year. I go, $5,000 a year, and how much is the year? He goes, $2 million. I go, so I do a little research, and I find out, why he didn't get his bill. And I took a little bit of a deep dive into the policy, and I said, "Hey, you know what? It's great that you're only paying $5,000 a year, but for $2 million, it seemed like it really wasn't a lot." And what happens is when you buy a cash value insurance policy, and again, he bought it 30 years ago, and what happens is every year in a cash value policy, they take out the cost of insurance every year. Now, while this may have been very well funded 30 years ago, the cost of insurance goes up every single year. So if you don't look at this thing over 30 years, and when it was originally designed 30 years ago, he only had it designed to run till he was like 93, 94 years old 30 years ago. Because who'd have thought listen, this covers a need I need now. I got my businesses thriving, blah, blah, blah. This will be enough money to cover it. And I know the insurance agent who had passed. He was a terrific agent. I'm sure, it was discussed. They did the right thing. But now he's 90 and that policy hasn't been looked on. Now, the other thing that happens with a policy, especially cash value policies, universal policies, whole life policies, depend on the performance of either some kind of driver, whether it's interest rates or dividends or growth from like in a universal policy where an insurance company pays you an interest rate. Well, the cost of insurance comes out of that policy from the premiums you pay and the policy and the cash value that's built up in the policy. But back when he bought it 30 years ago, interest rates were 8, 9, 10% inside that policy. And then over the course of time, they dropped all the way down to 3% or 4%. And even with all that, initially the policy was only going to last till he was 94 or 95, and he's now 90. So I looked at the policy and I realized, holy cow, the cost of insurance is now $60,000 a year. That's the true cost coming out. And the cash value in his policy, he still had cash in his policy from the buildup, is now only $60,000. He's put in $325,000 over the last 17 years or 20 years, but the total amount of cash in there is $60,000. The death benefit's still $2 million. And on this statement, every year, whenever you have a statement, there's usually, and people don't read this, I understand it, but the insurance company is not telling you, hey, you got to pay more money. But they do have a little clause in the statement that says, hey, I just want to let you know that, under current interest rate, your policy is going to last till you're 92 years old. It's not spelled out tremendously. I don't know the legal requirements of what they have to spell, what they don't. But here's your bill for $5,000. And then he's going to wake up next year and say, hey, you got to come up with $100,000 just to keep this policy going. And that is a rude awakening for somebody. Because like him and everyone else, they're not really reading that statement in detail, nor would I expect you to understand that statement in detail. I do. And that's what brought it to my attention and said, hey, by the way, Mr. Jones, I don't know if you realize this or not, but next year you're going to have to come up with $120,000 to keep this policy going, or it's going to lapse, which means your heirs will get zero. Now, I'm telling you this now so that you know and understand you could prepare for, you got to start coming up with more money, or we could possibly sell it for you. And that's what a life settlement is. So I want to give you the option of understanding what the future costs are going to be. Now, if you die tomorrow and your wife dies tomorrow, your heirs are going to get $2 million. I don't know when you're going to pass or anything else, but I'm just telling you that in order to keep this going, you're going to have to start paying a lot more money. Now, most people don't have that conversation because they don't even realize it. You're looking at a statement, you don't even realize that this is a potential situation. And who the heck remembers from 30 years ago exactly what you bought or exactly how it's performed? And if somebody's not reviewing your policy on an annual or every couple of years, or you're not reviewing it in detail, you may not know. So now you're in a situation where you may have to sell your policy or come up with a lot more money. I want to give everybody all the options. So, what could I get for that policy? He asked me. So, I don't know. So, I go and I shop it to see, hey, what I get. I want to lay out all the options for you. So I'm going to tell you where this journey has taken me with this one policy, and I can't believe I'm running out of time right before the break. But right after the break, we're going to tell you a little bit more about how this is all developing. You're listening to the Main Street Code for Financial Success. I'm Neil Himmelstein, and the best way to reach me is 631-647-4694, or visit me on the web at themainstreetcode.com, and we're going to be right back after a quick commercial. Thank you. Welcome back to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein, and I look forward to talking to you about your financial situation. Before the break, we were talking about our 90-year-old client who had a policy of $2 million, and all of a sudden, he's going to have to start coming up with more money or has the option of selling it. Now, if he sells the policy, it's called a life settlement. And I want to get into what life settlements are. Life settlements are a product of a purchaser buying your policy and basically taking over the death benefit. So whoever buys that policy, and it's never an individual, by the way, okay, and I want to make this very clear. It's usually a hedge fund or a big company that invests in policies as an investment, as an asset class for them, knowing that there will be a return at some point. So you have to understand the buyer's perspective. They're only going to buy things where they feel they can make a certain profit. You know, typically they want to make 15% because they're looking at that versus buying stocks that say are mutual funds or other investments that they figure will earn them 10% and they'll double their money in 7 years. So people don't understand, well, it's $2 million, but how much can I get for this policy? So they're going to give you a sum of money, okay, and they have to pay the premiums of the policy until you pass to collect their money. So just because it's a $2 million policy, you're not going to get $2 million for it. You have to realize your expectations. And you have to realize whatever they give you, plus whatever the premiums, and then they got to look at a profit on that, if that makes sense. So he said, I feel what this policy is worth, basically, in my mind, is maybe I can get $500,000 for the client. Maybe. I don't know. So how does a company evaluate what to pay for a policy? That's the next step. So basically, what we do is they want to look at what's the life expectancy of the clients. Just like a life insurance company would, when you buy a policy, they're looking at your life expectancy, how long you're going to live. Okay. Somebody buying your policies is looking at when you're going to die. Now remember, this is not an individual. If an individual wants to do this, you get nervous. I had an 80-year-old man one time that said to me, hey, listen, I'm really nervous because I'm selling all these policies and I got to knock on the door for our pizza delivery, and it wasn't for my house, and I was concerned because I'm selling millions of dollars of policies, and is somebody here to knock me off? No, absolutely not. This is purely, it has to be a company, and if it's an individual, walk away, you're not looking, no. These are companies that buy it as part of an asset class. They're buying hundreds of policies, not just yours. You're just a name in the bucket, so you know. You're a real estate holding to them. You need to understand that. You're a real estate holding to them, And in selling your policy, it's like selling real estate. Okay? It's very, very, you need competition. There's a lot that goes to it. So the problem is, if you call company direct, and you hear them on TV all the time. I mean, I can name names. Oh, your company's worth something. They got guys in a tunnel. They got, oh, you could sell your policy. That's what we're talking about. It's called a life settlement. Okay, selling your policy. So if you go to sell your policy, you want to get the most value for it. If you go to a company directly, you are not going to get your value for it. Somebody's going to offer you a BS offer. Okay? So initially, even they went to me and said, how much do you think it's worth? Well, the initial offering to them was $350,000. Okay? I said, no, that's not acceptable. That's not enough for a $2 million death benefit. I can do math. Okay? I'm really good at math. And in my head, I'm thinking it's worth closer to $500,000. Okay? So we go and do their medicals and everything else, and we're now up to $500,000. Okay, but the seller is very savvy. He asked me a very key question, and most people don't know this. Okay? Believe it or not, I learned something this week. See, I learn something all the time in this business, and that's key. You want somebody who's up on taxes and law and changes and why you just can't go to Joe Blow and get things done. You need to come to people who really know what they're doing, who are on top of their game. His concern was, if I got $500,000, what would my taxes be? Well, you would get a 1099 for that sale. And the difference between what you've paid in this case, he paid in $325,000 and $500,000 would be taxable. And you get a 1099 for it. Well, luckily, he's speaking to Neil Himmelstein, because guess what? I found out where he can get it tax-free. How is that? Well, there's something that people know about and they've heard in their past, and I've spoken to accountants and attorneys, and there's something called viatical settlements. I'm talking about a life settlement. They're two different things, but they're really the same thing. The difference between a viatical settlement and a life settlement is the criteria for a viatical settlement is somebody maybe who has 2 years to live, or the IRS just deemed this, has a chronic condition like long-term care. So if they can't perform 2 out of 6 activities of daily living, now this client is 90, his wife is 90, okay? And I know she can't, and I'm pretty sure he can't. He's got enough things. Then he can qualify it as a viatical settlement, not a life settlement, and get a different type of 1099 from the buyer. It's called a 1099 LTC. I wonder what LTC stands for. Long-term care. Okay? And if he gets that, it's tax-free. So now, not only have I gotten him from $350,000 to $500,000, I've made him an extra $150,000 for talking to me and working with me for a couple of months and going through the medicals and everything else. It's how I get the price up and then bid one guy against another. So the initial opening is $350,000. Now we're up to $500,000. This is real. Okay. So if he had just taken the first offer and said, well, I can't afford to pay for this anymore, I'll take my $350,000 and I'm done. Well, wait a minute. I'm going to give you $500,000, but $175,000 that's going to be taxable to you. Well, I don't know if I want to do that. Now I'm telling you, I'm going to give you $500,000 and it's going to be tax-free. Now, I've not only made him an additional $150,000, I've saved him the taxes on $175,000. So at 30-40%, you do that. That's state and federal taxes. You're talking another $60,000. Most people don't even know this. I'm telling you, I sat with a meeting with an accountant. Wait a minute, you got what? How is that possible? It's tax free? Yes, it can be tax free, but not knowing a professional and staying up to date with all the tax laws and all the things, you would never know that. That's the difference in working with us, is that we look at everything and try and get you the best offers, the best deals. And with being independent, we can do that and not working for one company. And that's very important in this world. And that's how we do life settlements a little differently than your average Joe walking up and down the street. You've been listening to the Main Street Code for Financial Success. I'm Neil Himmelstein. I welcome your questions and comments. Give me a call, 631-647-4694. Have a great weekend, everybody.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.